Today, we are talking about how to protect your retirement from a sudden downturn in the market. The number one reason retirees run out of money is a poor market right before or right after retirement. You might have a solid plan for retiring in 5 years, but how do you make sure it's not derailed by a financial storm at the worst possible time? This is what keeps a lot of pre-retirees up at night, because it is devastating to see your 401k shrink overnight. But the good news is there is something you can do. Over the past 8 years, I've helped dozens of people retire successfully, and they all followed a pre-retirement process instead of leaving it up to chance. So in this video, I'm going to break it down for you, the 3-step framework for how to retire in any market condition. By the way, I'm Rachel Camp. I am a CFP professional and the founder of Camp Wealth, and my firm helps individuals retire before age 65. All right, let's dive in. Now, before we get into the 3-step framework, there is a critical first piece that you have to understand. This is the thing that kind of blew my mind when I was first learning about retirement planning almost a decade ago. Creating a successful retirement plan is all about making it through bad markets. Duh. But the real danger lurking in retirement planning isn't just market crashes, it's when those crashes happen. You see, a successful retirement income strategy really boils down to one single principle: timing. Timing matters a lot more than most people realize. If the market tanks right before or right after you retire, you're in a much worse position than if it happens in the second half of retirement. In fact, you could take 2 retirees who have the exact same average return of 8% over 30 years, but one is going to be allowed a much higher safe withdrawal rate, while the other one may have to stick to the traditional 4% safe withdrawal rate to avoid running out of money. And it is entirely due to the order they experienced their returns. The one with the higher safe withdrawal rate started with a good market in retirement and later experienced a bad market, while the one sticking to 4% started with a down market and recovered later. This is what financial pros call sequence of returns risk, and a poor sequence can be a retirement income killer. But here's the thing very few people talk about. It's not just about a down market once you're retired. This problem of bad timing actually starts a decade before retirement. And this is called retirement date risk. And it's the risk you will have to retire later than you want to, all due to poor market timing. And the culprit is portfolio volatility. If you want to retire by age 65 with a $2 million portfolio and you experience a bad market toward the end of your working years, you might either have to retire later than you want or retire at age 65 but spend less than you want. And here's an important piece to understand because I see a lot of people fight against this. What happens in your final decade is your retirement contributions, this is the money you are putting into accounts, they have a really small impact. After decades of saving, the returns of the portfolio take over. This is due to compounding, and new contributions barely make a dent. If you are in your final decade of working and the market is falling, your contributions will have minimal impact. It's like trying to fill a bathtub while the drain is open. You're fighting a losing battle. The returns of the portfolio at this point in time are in control now. So now you understand the risk is not just about how you start retirement, it's also important how you end your working career. So the question is, what do you do? There are 3 steps you can take when you are within a decade of retirement to minimize your retirement date risk. Step number 1 is to build your retirement runway. Jonathan Guyton wrote a piece in the Financial Planning Journal titled On Retiring into a Bear Market. And the key point he made on surviving a bad market when you retire is having unaffected assets. And the point he makes is that remember that a safe withdrawal rate was created to navigate bad markets both early and late in retirement. I've talked about it before, but the 4% rule was not created for a good retirement or even an average retirement. It was created to survive that worst case scenario. But what you need to get through these bad markets are unaffected assets, assets that remain stable while other assets are falling. The classic example is bonds, specifically short-term bonds that have very little volatility. Now, as this chart points out, in recent years, stocks and bonds have seen a higher than normal correlation which means when stocks fell, bonds actually fell alongside them. But the only other time in history that this has happened, it occurred in 1978 to 1981. Quarter one of this year's shows a very different story of returning to the norm. So we show a return to negative correlation between stocks and bonds. So stocks fell at quarter one, especially the US stock market, while bonds rose. So creating a portfolio with unaffected assets allows you to draw income without touching the assets that are currently losing value. But the other thing this is going to do is to decrease your retirement date risk. Remember, the driver of retirement date risk is volatility. So the easiest way to reduce this is to add asset classes with low volatility. And you can start creating this runway or unaffected or uncorrelated assets a decade before retirement. Now, how exactly do you do this, right? Because there's a few different ways. You can do it all at once, but you risk a tax impact with the shift and timing it poorly. You could do it gradually by just changing your contributions to go into 100% fixed income, for example. Or you do a hybrid approach of shifting equities to bonds and allocating contributions to fixed income. There's not a perfect science here that I have found because a lot of it depends on Mrs. Stock Market and timing it correctly. But something that may help you decide is looking at your required rate of return. All right, now a lot of you asked last time I used this calculator what this calculator was. It's just a financial calculator online, but I've included the web address here so you can go to it if you want to try it yourself. All right, so let's say you are 55 years old, you want to retire in 7 years, you have $1.5 million currently in your portfolio, you save about $40,000 a year, and you want to retire once you hit $2 million. So if we put these numbers in and we solve for your required rate of return, we see your required rate of return is only 1.8%. That's really low. So with this required rate of return, you really don't have a lot of need for risk. So if you really want to make sure that a bad market doesn't derail your goals, you could start shifting quite a bit into fixed income and out of equities. On the other hand, let's say same situation here, but now you only have $1 million. So if we solve for the $1 million portfolio, your required rate of return is now 7.41%. So your trade-off is needing to stay in equity so you can get there while understanding that equities will increase the volatility in your portfolio, thereby increasing the retirement date risk. Now, earlier I said contributions at this point will make a minimal difference in the last year of working. And now for the most part, that is true, unless you are able to contribute quite a bit more. And if you are, you could bring down the retirement date risk by quite a bit. So step number 2 is to increase your contributions. If you are within a decade of retirement, increasing your contributions could have 3 massive benefits. First, you are increasing your initial starting balance in retirement, which means a higher withdrawal rate. Second, you are reducing retirement date risk. And finally, third, if you do experience a down market, these new contributions may grow after this market volatility. Now, it's a perfect time, the year 2025, to be talking about this. We've experienced a lot of volatility this year. The start to this year was awful, especially for US investors. But for those who were diligent about sticking to their contributions, they are already seeing a payoff from this. Now, this trend may continue, it may reverse, it may stay relatively flat. It's been a perfect year to demonstrate how ineffective attempting to time the market really is. Now, while continuing these contributions help to reduce your retirement date risk, you'd have to really increase contributions to make a large difference. So this means taking advantage of the catch-up contributions you receive when you turn age 50, or adding more to your brokerage account after you've maxed your retirement accounts. This may be easy if it lines up with paying off your mortgage or a decrease in expenses due to your children maybe leaving school. But for many people, it is easier to adjust their existing investments instead. Now, this is where step number 3 comes into play. Now, step number 3 is one where I see a lot of people making a massive mistake due to recency bias. Recency bias is the bias we have when we make decisions based off of recent events and ignore longer time horizons. So step number 3 is to diversify your equity holdings. The S&P 500 has been on a tear since 2008. It has outpaced almost every other asset class, but that has not always been the case. You see, what happens historically is sectors rotate. And what we mean by this is while the S&P 500 has been on a tear recently, the large cap sector, which is the S&P 500, has had poor periods of time as well. This year has been a great example of this, at least the beginning of this year. This chart shows what happened in the first quarter of this year, where the S&P 500 posted negative returns, while international equities, on the other hand, posted positive returns. And we've seen this play out if we look at history. The US and international markets trade periods of outperformance. This also applies to sectors within the US. Again, while the S&P 500, which is the large cap sector, has performed really well, small cap has had great periods as well. The key to equity diversification is increasing your risk-adjusted return. Now, if you want me to do an entire video on investment diversification, let me know in the comments below. I don't have the full time needed here to do it justice. What you need to know now is if you face long stretches of time of poor performance in one asset class, it's important to have uncorrelated asset classes in the portfolio to get you through these bad times. And not just bonds, but within the equities category as well. If you're looking for more help with your retirement plan, click the link in the description to book a call with myself so that I can show you exactly how to implement these strategies in your specific retirement accounts and protect your savings from market volatility when it does show up. I'll see you in the next video.